At Bitcoin Market Journal, we've got a hot take on investing. We combine old-fashioned value investing with newfangled crypto investing to deliver far better results. And our approach is simple. We make monthly investments into a diverse mix of stocks, bonds, and no more than 10% quality crypto assets. We hold on to them for the long term, 5 or more years. Here are the results, which have far outperformed individual investors who stay away from crypto. We call them the non-believers, and we pray for them. We've had 5 years to explain why this approach works. You can read the thousands of articles, research reports, and investor scorecards on our website, or you can watch this quick video series. Today, how to avoid bad crypto investments. 99% of crypto investments are bad, just like 99% of company investments are bad, meaning they're just not worth your hard-earned money. Here are some principles for avoiding the bad ones. First, meme coins are fool's gold. We avoid any crypto investments based on crowd excitement with no underlying value. And even professionals can get caught up in meme coin mania because they seem so cute and harmless and they're usually cheap. But ask yourself, what fundamental value are these adding to the world? They don't have a product or service or revenue. And that makes investing in meme coins a lot like gambling. And gambling can be harmful to your wealth. Next, avoid teams without integrity. Contrary to popular belief, the best crypto companies have a combination of strong centralized leadership and a strong decentralized community of developers and investors. You can use our investor scorecard to find great companies run by great managers. Above all, avoid companies run by anonymous founders or leaders. If you don't know their name, run away. Avoid new token offerings. Investing in a new crypto project is a lot like investing in a startup. The odds of failure are very high, so it's best left to people with money to burn. Again, we want to invest in proven crypto companies with a user base that's strong and healthy and growing. Avoid new market segments. Maybe one day decentralized file storage will be a thing, but today most companies are pretty happy with the centralized alternative. Same thing goes for decentralized social and layer 2 solutions, cross-chain bridges, and so on and so forth. Again, we want to stick with proven use cases, with real companies, with projects that are strong and growing. And finally, avoid NFTs. Our view is that the technology behind NFTs is super valuable, but most actual NFTs are just like collectibles. So think of them like classic cars or Pokemon cards. If you absolutely must invest in NFTs, try to keep it to no more than 1% of your overall portfolio. And ask yourself, what value are these NFTs really bringing to the world? Note these principles are totally different from what you'll hear on most crypto sites, which are all about hyping the flavor of the month. But these principles make logical sense and they will serve you well for the long term. Stick to great crypto companies with a great product, great leadership, and a great user base that's strong and growing, and avoid the other 99% of crypto projects out there. The final lesson in our video series is coming up next. It's about how to take the long view. Keep watching.